Hey Cliff,
How you doing, Mark?
good. How are you?
Good.
Good. Hey, Cultivation has had a hell of a month.
We've been kind of busy this past month. You might have noticed.
Yeah, you had that 4 million raise from Textel. I think it was 25 million with Matic, and then 20 million with Finlocker and 10 million with Balto. What is behind that?
Well, some of it was just that we were working on a lot of deals over time that got announced all within the same week. But
Coincidental?
overall, I'd say that we have stayed busy during the pandemic era. We certainly back in March paused and were a little worried and looking around us and trying to understand where the dust was going to settle. But pretty quickly, we realized that the pandemic represented more opportunity than risk. And what we found is a lot of other firms were backing way off and really just absolutely turning off their spigot. Yet a lot of great startups were still going. And in fact, what I found is that a lot of companies that are digital first were actually doing better in the pandemic environment, not worse. So, however, the capital markets were somewhat constrained, at least with a lot of the firms that we usually collaborate with. So, what we found was great opportunities to invest and to support great entrepreneurs, and that hadn't really changed. So, we pretty quickly got back up to speed and have been busy ever since.
Now, when you say that companies were turning off their spigot or different, VCs, you may have noticed the community were turning off their spigot. Was it for all deals or just a type of deals? I'm wondering what we're going to see with brick and mortar and whether everyone just took all their investment dollars and moved it over to cloud and digital, or whether there was maybe a decrease on both sides, both the brick and mortar economy and the cloud economy.
Well, initially in the early stage venture world, we did see some investors um, uh, pull back their own capital for the purpose of holding that for their own portfolio companies. So, very reasonably, I think the concern was that we didn't know what was going to happen to the economy, and we didn't know what kind of support our existing portfolio companies might need. Um, so, there's absolutely that is a reasonable perspective, and we were thinking that way too. We were fortunate at Cultivation to be fairly early in our fund cycles, which meant that we had a lot of capital still to deploy for new portfolio companies. So we were able to both budget for our own portfolio and continue to grow the number of companies.
Has this changed your thesis at all? Are you all looking for different types of investments now than you were 6 or 9 months ago?
It has. We are more wary of complex enterprise-wide um, companies that require approval from multiple departments. So that's kind of a
Huh.
mouthful. But what we found is that in some environments, um, software companies were finding it easier to sell. They were able to get directly to decision makers a little easier. Decision makers might have found that they had a little bit more time on their calendar because of some efficiencies that got made up by working at home. Um, uh, for some people, once we kind of got through the crisis the first couple of months, a lot of business leaders were using that extra time to take care of loose ends, work on projects that were sort of in the hopper, but were always kind of in the hopper and not getting to them. So doing things like technological improvements sort of moved to the forefront. Where we found that became a liability is when a certain software purchasing decision requires the collaboration of multiple departments within a large corporation. And if it got to be a point where a high degree of collaboration was needed inside a company to make a purchase, we find that those purchase decisions are slowing down because collaboration in companies is less efficient. So individual productivity might be higher from work at home, but corporate collaboration was less efficient as a result of work from home. So we are a little bit more cognizant of very complex multi-department type of sales cycles or sales processes, and are a little bit more attracted to companies that are able to sell into a single department and where a single decision maker can give the go ahead to move forward with the product.
Yeah. I heard two interesting things there. The first is that there are types of businesses where you are collaborating across departments in order to get a solution through. That's what your buyers have to do, and that
Correct.
those sort of businesses right now are struggling because of the second thing you mentioned, which is that communication is less efficient. Do you think that that's a result of remote work, and is that going to happen forever, or do we think that people are going to get better remote work? And if you're that kind of company that usually has a more complex buying process, your buyers just kind of have to work out the kinks a little bit until they're able to figure out how to buy again.
I believe that is a temporary phenomenon, that it is impacted from work from home environments, and it will have to improve. And so I don't know how long that'll last. I wouldn't be surprised if it would take a year for companies to find efficiency with multi-department collaboration. That might have been a little easier when you could walk down the hall and knock on your colleague's door. Yes, I am optimistic that we'll all get better at remote working. This is very new for a lot of us. Even our own firm, we always had partners in other cities, but the majority of the people were in a given room and we had partner meetings. And since March, we've gone completely digital. And I'd say that we've gotten much better at being digital and much better at incorporating the feedback and the collaboration between our partners who do live in other regions now than we were before. So we're a better firm today because we were forced to have to get good at remote working. And I think that'll be true for more complex corporate organizations as well.
Yeah, that's so interesting. I can't imagine a world where an entire section of the economy, every sort of complex solution gets cut out because people can't collaborate in order to buy it. I have to
Of course
imagine
not.
that economic gap, that need will be filled. Uh,
And just to be clear, they're not buying, it's just taking longer. So the
right.
sales cycles are taking longer. And so when you have a longer sales cycle, it takes longer to close. That means your growth rate slows down. And
Very
so
interesting.
much in venture, I think it's easy for people outside of the venture not to realize we are really obsessed with speed. And I don't think that makes sense to a lot of people, but as a company, a venture capital firm is judged by really two criteria by our investors. People forget that VC firms have investors too. Even though we invest in other companies, ultimately we have to answer to the investors who invest in us. And they judge us by two prime criteria. That is the return on capital, right? The cash that is returned to them. And the second is the amount of time it takes for that cash to be returned. So time is as equal of a criteria for us, a success factor, as is the return on capital. And ultimately, those are blended into a concept called an IRR, or internal rate of return, in which those two factors are put together into one number. And IRR is how our business is evaluated. That is our benchmark. So time is very important to us. So a company that might have a slowed down sales cycle, they'll be fine in the long run. And I do think the companies are going to work it out. And I think they're going to be successful companies. And those entrepreneurs are going to do great. But if there's going to be a slower sales cycle, that's going to mean it's going to take longer for that company to get to scale. It's going to take longer for us to get a return on our capital when we invest in that company. And it's going to push our IRR down. So time does matter. Growth rates matter, speed matters. They all ultimately end up being part of the criteria by which we're judged by our investors.
Right. So then in that case, do you see financing for those companies picking up in about a year when remote work starts to get a little bit more efficient and more common?
I do, and quite frankly, when their growth rates curve back up,
Yep.
the interest from investors is going to go right along with that growth curve, no question. Companies with great metrics raise capital. I think what a lot of people in the market don't realize is just how selective these metrics are for venture investors. I mean, the expectations are just so high. I think a lot of people don't even believe that it's possible, but it is possible. And there's a reason why only 2% of startups receive venture capital, because we're only investing in the top 2% of financial performance for companies. And so
Right.
that's usually companies that are at least doubling their revenue every year. And many of them are doing, better than that, are tripling or better their revenue every single year. And trying to manage an organization with that growth rate is really challenging. It takes really a fabulous management team that can handle a lot of turbulence to be able to manage through that kind of growth.
Right. So then if you're a startup, how do you want to make sure that you're hitting the right benchmarks, that you are in that 2%, and that if you're not, you know where to optimize for?
Well, one of the things I always coach entrepreneurs on is you tell us what your benchmarks are. So I think one of the most important things you can do as an entrepreneur is identify what are the milestones of your business. And a milestone is any point in the growth of your business that recognizes an increased level of success. Usually what that means is it's a reduced sense of risk in the mind of an investor. And every company is different. I think we all assume that it's just all about revenue growth, but that's not true. There are many kinds of benchmarks or milestones or metrics that represent success of different companies in different industries with different business models. For example, an obvious example would be for a life sciences company, it's not about revenue at all. It's about the development of their technology, right? It often has to do with their clinical trials and their approvals through the FDA and the success of their research. And so every entrepreneur needs to think about what are the success metrics for my business, and they need to pitch the venture capitalists and other investors what their success metrics are and prove to them how they've been meeting them and are meeting them at a fast rate, at a high growth clip. And it's not always revenue. It's not always revenue.
Very interesting. One of the things that kind of stands out about Cultivation is that you guys have a top tier life sciences portfolio and top tier ag portfolio or ag tech. What are some of the ways that those companies are run that if you're in SaaS, you could learn a thing or two for how people run a life sciences company or an ag tech company?
Interesting question. I think that it really comes down to the same concept of understanding benchmarks. As a manager, as a manager of a startup, it's not possible to do everything perfectly all the time. And one of the issues that I see with people who come from corporate and move into startups is they're accustomed to being in an environment where every T is crossed and every I is dotted, and everything is optimized and managed as perfectly as possible. And they get into a startup and they're shocked and even uncomfortable with how many loose ends are all over the place. I don't know if you're familiar with this, Mark. Maybe you can plead ignorance, but there are tons of things that are left undone, unaccounted for, not done perfectly well. And you have to be comfortable with that certain level of chaos when you're managing a startup because you have limited resources. And you need to focus those limited resources, including the limited resource of the attention of management, onto those things that move the needle the most, that impact the business, that move the business the furthest, have the most forward progression, right? And if you're taking care of everything and watching everything and managing every detail, you're not focusing your energy and your resources into those things that matter, which means that sometimes you have to let some things that don't matter as much, you got to let them go. And that is how you need to manage a startup, is concentrating your resource into what matters and letting some of the secondary and tertiary things fall a little bit by the wayside, just a little bit, right? And that's the kind of intensity you need to have to be able to move that company forward at that kind of rate with limited resources. And I think that is consistent whether it's life science, ag tech, or software tech, is the same idea of concentrating your resources and being willing to let the small stuff go. When you have a smaller number of objectives, you're more likely to achieve them and achieve them in a bigger way. As the company matures, then you start tying up the loose ends. And really with each sort of sign or level of maturity, whether it would be the A round, the B round, the C round, you're tying up more loose ends as the company grows and matures. But if you started day one operating a startup company the same as a major corporation, I guarantee you're going to fail. And so I think that's what's interesting when you get entrepreneurs from different industries talking and working together, is they all have to operate under that same intensity of focus,
Yeah.
and focusing on just what matters.
Yeah, Cliff, I'd actually say it's probably one of the biggest things that I've learned in the first few years of founding a company. And that is, and I say this to folks at Balto all the time because I want to let them know that not everything is be perfect. And what I'll say is, sometimes things are on fire and you just have to let them burn. And
Yeah,
that doesn't
it's a
mean,
controlled burn. It's a
yeah,
controlled burn, right?
exactly. You make sure that the right
It's a
section
fire
of
line.
trees is going out, but it's not like spreading across, the entire, Southwest. But yeah, it's about, knowing that there are a million things you could fix and a million priorities you could address, but you have to choose a few. And
Yes.
that means that there are going to be things that are not as good as they could be, and especially for, I would say not even just folks in the corporate environment, but also folks who are recently out of school, because you're in school and you get graded on every part of your paper being as close to 100 as it can be, and
Right.
then you get to a startup and the answer is some parts of your paper should be a zero. Like take a couple paragraphs and just like, just rush through them, and then some paragraphs need to be 100. And imagine if your English professor said, I want you to
110.
write exactly. I want you to write a great introduction. I want you to write a great first body paragraph. Let the next four body paragraphs just totally slip and then give me a home run conclusion. You'd be like, what?
I am so guilty of that. When I came out of school, I started a chain of healthcare centers.
Yeah.
And I was probably the same inclinations you do, to be a perfectionist. And I had a vision, right? I had a vision of what I wanted the customer experience to be. And my focus was really all around the customer experience. But I took that to such a level of detail, I drove everybody crazy. I mean, it was to the point where like I was very specifically cultivating the magazines on the waiting room table and how they're spread out. And I was so bad. I would only allow them to play certain music on the radio when people could listen to in the waiting room. And I would, and literally I would monitor the smells, like into cooking like chocolate chip cookies and things, so that there was a certain smell. Like I was so into the ultimate detail of every single part of that customer experience. I was really missing what mattered the most. And that was, the experience that the patient had with the doctor, and ultimately revenue
Mm,
per patient visit. And so, we had the cleanest magazine spread you've ever seen in your
mm-hmm.
life, and like the most perfect music you ever heard. But we weren't really paying attention as much as we should have been to other things that really changed the economics of the business. And so
Right.
it took me about 2 years before I really figured that out. And fortunately, I didn't drive my employees crazy. They actually stayed with me through that process, shockingly. And
Builds
kind of came to
character.
that realization that let's focus on just the things that move the needle. And of course, you can imagine the economic performance just it increased to a level that wasn't even explainable by those changes. It's amazing that when you focus your energy and momentum in the right way, momentum begets more momentum, and things just start taking care of themselves. And I certainly found that when I reduced the number of um, benchmarks or metrics that we monitored for what it meant to have a successful clinic. We reduced it to things that really mattered the most to the patients
Yeah.
and to the business. And that's true of in any industry, right? Whatever you're trying to accomplish. Now, I get it. When you get to be a large corporation, the rules change, and you worry about liabilities, and you become a target for lawsuits, and there's very high expectations, and you've got the resources at that point to kind of take care of all those loose ends. But
Right.
as a startup that's growing, right, you're growing into those expectations over time.
Right. Cliff, one thing that's so interesting about what you just said is that I think that your thinking going into it was directionally right. It was, let's obsess about the customer experience. Let's make sure that every detail that customers do experience feels like we would want it to if we were going in and buying some solution. And in Bob Iger's book, the former CEO of Disney, he mentioned how he was guilty at times for choosing which chandelier they would use in various Disney hotels. And
Right.
he said, I wanted to choose the chandelier because I wanted to have that beautifully executed, down to the detail vision of how to do things. And when I'm giving feedback to the Balto team about where I think I can be most helpful and least helpful, what I tend to say is try to involve me in the way beginning of the project, so I can help provide guidance on what this could look like at the end. And then you can also bring me in at the way end to try to like get to the heart of those little details to make it awesome. But that middle zone where other people want to be taking their own vision and making their own vision happen can't have multiple captains, I think.
Well, you bring up another interesting adjacent point, and that's the idea of training your team to buy into the vision, but to be able to make their own decisions to execute on that vision kind of within those parameters versus trying to control every single eventuality and train them on how to handle every single eventuality. And I think what we find is the latter doesn't work, and that you're much better off training your team how to make decisions in the right way, how to make decisions that are consistent with the values, the strategies, the visions of the firm, but make those decisions on their own within those frameworks versus trying to anticipate every single little thing and tell them what to do, like picking the chandelier. Like
Right.
if you can train someone how to pick a chandelier, let them pick the chandelier. A great example of that, I really learned that lesson from a friend of mine who went through the training program at the Ritz-Carlton. The Ritz-Carlton is a fabulous, probably one of the most respected customer service training programs. And it was at least back in the 90s or early 2000s when he went. The framework of it was this idea that we are ladies and gentlemen serving ladies and gentlemen. And that was sort of the big mission statement, right? That idea of we're ladies and gentlemen serving ladies and gentlemen. And they were taught that they were, first of all, their answer is to say yes and then figure out how to do it. So when someone comes down to the desk and says, I need something, first of all, they think of them as a peer. They think of them that what would I want as a lady or a gentleman? How do I serve this lady or gentleman? And the answer should be yes. I just need to figure out how to do it. And they're empowered with the authority to make it happen. Versus the other approach would be, all right, here's a training manual. And if someone asks you for an extra pillow, you do this. And if someone asks you for an extra bottle of water, you do that. And if someone says the neighbor next to me is noisy, you do that. Instead, the Ritz-Carlton teaches you how to make your own decisions within the framework of their culture. And it's very effective. And, they're well known for having great customer service, delivering a great product and charging a premium for it. And I like to think the same way in other businesses to teach people how to make the right decisions rather than tell them what the decisions always are in every eventuality, because you'll never possibly predict every single eventuality.
Right. So if you're a leader at a tech company or a startup and you're trying to ingrain that into your culture, where do you start if it's not the training manual? Does it start with an impassioned speech on day one? Does it start by organically introducing new hires to everyone else in the company to try to pick up their habits? Where do you start? How do you actually make that happen?
I think it starts with an impassioned speech on day one, and then another on day two, and then another on day three, and so on.
Yeah.
It takes constant reminders. In my healthcare company, that was probably the most difficult thing. Is I was trying to create a healthcare experience that was different, that actually put patients first and had them, and that was focused on customer service, where lots of times you go to a physician's office and it's not about customer service. It's about putting you through the machine, right? And it took a lot of reminders constantly every day, reminding people what we stand for and what we're about. I took other opportunities to show reminders. For example, the way we decorated the office set a certain tone. Our marketing materials reiterated the tone and the theme of the business. Everything we did reiterated the theme of the business and the vision and the mission of the business. And yes, it took constant reminding, because not everybody was always on board. They'd say they're on board, They say that sounds great. They nod
Yeah.
their head. I love it. And then they don't do it. They fall back to what's familiar. Ours was a particularly interesting situation because I was trying to go against the prevailing culture in our industry.
Mm.
Ultimately, one of the things that worked very well for us is we stopped hiring people that came out of the healthcare industry. And so when it came to office staff, we didn't hire people that had healthcare experience. In fact, if they had healthcare experience, it was mark against them. We were looking for people that experience in retail, in sales, and customer service, and then we teach them healthcare. So we hired for their point of view and for their cultural perspective, and then we back taught, kind of how to do healthcare coding or how to work the patient record system, wherever the
Yeah.
case might be. Now, I think the nice thing about in startups, at least for tech startups, there's already a great culture that wraps around the tech startup world. So you don't necessarily have to undo or fight against prevailing cultural trends because they're positive. It's about working together as a team, being highly collaborative, working really hard, doing whatever it takes to get things done. Those are all the kind of things you want. But it does make you cautious when you hire to make sure that the people you hire do buy in to that culture and that they are familiar with it and they do know what they're getting into, because they're going to bring their point of view and their work
Right.
experience cultures with them to your organization. And you don't want to have to fight against enemy culture. You want to, support and propagate, the culture that helps advance the business.
Yeah, that's one of the things that we think about and talk about a lot at Balto is, where does experience help? Where does experience hurt? And in the places that experience helps, how can you reverse engineer the outcomes of experience? So if you
I
think
like that.
about experience kind of in a reductionist sort of view, I think we kind of um, like sensationalize experience, which is it's something you get just by being older and having seen stuff, and there it's just kind of washing around in your head, and then just at the right times you pluck out the right information. That's experience. And I think that in some ways it's true for sure. There's some intangible piece that you can't really put your finger on, but there's also bits of experience, which is, can you get better at making decisions under pressure? That's something you get with experience. Can you
Mm-hmm.
get better at pattern recognition and invest in your ability to pattern recognition? Can you improve your network? Those are all things that you get with experience that you can kind of reverse engineer and say, how can I teach those specific things to the organization? So
That's
one of the
true.
things I've been wondering recently is, and I've been thinking a lot about, is where do first time founders tend to lack some sort of skill or some sort of ability because they don't have that experience? And what should first time founders be learning early on that someone who's done it before might already know?
Well, I look at this from two ways. So one, I guess I'll say, what do I look for in a first-time founder? And then I can maybe go back to say, then how can somebody develop those things? First, I would say I find that great founders have a sense of urgency. They are always in a hurry to get things done. They're anxious, and if you look at their history, they have a pattern of accomplishment and of output and of productivity. So I'm very concerned when someone's got a startup, but there's nothing in their background that represents a tendency to overachieve,
Mm.
because what's going to change now? And so to a young person who is contemplating being an entrepreneur later, I would say accomplishing things now is going to give you the practice and the frame of mind to be a high achiever later. So, not everyone is going to be high achievers in the same things. It doesn't necessarily mean you get straight A's in school. Certainly that is a kind of achievement, and, it's good to see. But if you don't have straight A's in schools, I want to see that you're highly productive working, that you were working at other companies, that you had impressive stats for what your accomplishments were, that you were leaders in clubs, leaders in sports, I want to see output. I want to see productivity, right? Of high quality productivity and a pattern of that for many years, because that I think is relevant, and we can extrapolate that you're going to approach your startup with that same kind of vigor. I also think it's really important to have someone who is hyper ethical. really operates with a high degree of a personal philosophy that's really obsessed with morality and ethics and what that means to them. As you know, an entrepreneur has a lot of opportunities to fudge things. They're usually the provider of the very data that they're being judged on. And ultimately, an investor has to trust them with their capital and trust that they're going to act in their best interests. And as you mature and as a company grows, you're going to find that not every decision you make that's in your personal best interest is in the best interest of your shareholders. And so you got to know that somebody absolutely sees it as a sacred trust, that the moment they take somebody else's dollar, that company is no longer about them. It's about the people who trusted them with that dollar, and that they have to be looking out for their best interests and put them ahead of their own. And that's it takes a special person to be able to do that, and that certainly isn't everybody. And I've seen companies, great companies, get taken down by founders who were selfish or looking out for their own interests. Now, ironically, of course, is there's nothing more selfish you can do than put others first, because people that put others first end up being very successful and rewards come back to them tenfold in the long run. But not everyone has that kind of vision. And so having that hyper ethical point of view, I think, is really critical and really important.
Yeah, it can be, and speaking from experience, really, really tricky. And I'll give you an example. A question that every startup and every company faces is, how do I treat departing employees? And in many cases, there is a gray area or option about what type of severance you want to offer, or perhaps how many of their options vested, because there was some gray area there, or how do you help set them up for the next role? There's a lot of questions like that. And on one hand, what is explicitly, as in on the balance sheet, best for the company is say, well, you are no longer working here, you're no longer contributing value to the company, therefore we give you the absolute most straight to the line company favored deal we can. But then you, of course, are balancing two things. One is the interests and ethics of the other person, which is, what kind of organization do you want to be? Not what kind of balance sheet do you want right now, but what kind of company do you want to be in the world? And then the second thing you have to ask is, now let's imagine that the departing employee, or whatever balance you're trying to make, is going to go out and tell everyone that's the kind of company they are. Are you going to be satisfied with what they say? So I think that balance is both critically important from just a, this is hard enough, can you go to sleep and feel happy with yourself perspective, and also of, are you cultivating a reputation for your organization that says good people work here, good people build things here? I think both of those are really critical.
Absolutely. Couldn't agree more.
Cliff, this was awesome. Really appreciate your time today. This was fun.
Thank you. What an honor to be on your first podcast.
First
someday
ever.
This will be historic. They will be playing it when they do like best podcasts of the millennium. They're going to pull back and find the very first Mark Bernstein podcast, and I'm going to be on it. How exciting.
There'll be a digital archive. And of course, at that point, the cloud won't even exist. It'll be like some sort of brain interface, and everyone's going to plug on their brain interface and pull up this podcast and say, wow, I'm listening to history.
Absolutely.
Cliff, thank you again. I'll talk to you real soon.
Thank you. See you later.
See you.
Bye.